Most investors think they understand bonds. They really don't, and the gap between what people think bonds do and what they actually do in a real portfolio could be costing you thousands of dollars every single year. So stick with me, because by the end of this video, you're going to see bonds in a completely different light. Let me start with a question. If I asked you right now to explain how a bond works, what would you say? Most people would say something like, you lend money to a government or company, they pay you interest, and you get your money back at the end. And yes, technically that's correct. But that surface level understanding is exactly why most investors make catastrophic mistakes when bonds are involved. Knowing what a bond is and knowing how to use bonds intelligently are two completely different things. Here's the first thing almost nobody tells you. Bond prices and interest rates move in opposite directions. Always. Without exception. When interest rates rise, the value of existing bonds falls. When rates drop, bond prices climb. This seems simple enough, right? But watch how many investors completely ignore this relationship until it's already hurt them. In 2022, when the Federal Reserve began one of the most aggressive rate hiking campaigns in modern history, the bond market suffered its worst year in decades. People who thought bonds were safe watched their so-called safe investments drop by 15, 20, even 25%, depending on the duration of the bonds they held. That's not a stock market crash. That's the bond market doing something bonds are fully capable of doing, and most investors were completely blindsided. Why were they blindsided? Because they never understood duration. Duration is arguably the single most misunderstood concept in all of fixed income investing. It sounds like it just means how long until the bond matures, but it actually measures how sensitive a bond's price is to changes in interest rates. A bond with a duration of 10 years will lose approximately 10% of its value for every 1% rise in interest rates. So when rates jumped from near zero to over 5% in the space of about 18 months, bonds with long durations were absolutely demolished. And this wasn't some black swan event. This was entirely predictable if you understood the mechanics. Now here's where it gets psychologically interesting, and I want to bring up something that genuinely changed how I think about investing. There's a book called The Psychology of Money by Morgan Housel, and I've linked it in the comments below. It explores how our emotions and mental biases shape financial decisions far more than logic ever does. It's honestly worth picking up if you want to understand why you make the choices you make with money. Because here's the thing. The reason so many investors get bonds wrong isn't purely mathematical, it's psychological. Bonds got labeled as safe a long time ago, and that label stuck in people's minds like a brand. Once something gets categorized as safe in your brain, you stop questioning it, you stop examining it, you just trust it and move on. That cognitive shortcut, that mental labeling, is exactly what sets investors up for a nasty surprise. Let's talk about what bonds actually are good for, because they do have a genuine role in a portfolio. The first legitimate use is income generation. If you hold a bond to maturity, you receive regular coupon payments and your principal back at the end. If rates are favorable, this can be a perfectly reasonable source of steady cash flow, particularly for retirees who need predictable income rather than growth. The second legitimate use is portfolio diversification. Historically, bonds and stocks have not always moved in the same direction at the same time. During equity downturns, bonds have sometimes held their value or even increased, providing a cushion that smoothed out overall portfolio volatility. I want to be careful with the word sometimes here, because as 2022 demonstrated, this relationship is not guaranteed. When inflation spikes and rates rise sharply, stocks and bonds can fall together, which destroys the diversification logic temporarily. The third use is capital preservation, but again with an asterisk. If you match the maturity of your bond to your actual time horizon and hold it to that maturity date, you will get your principal back regardless of what happens to bond prices in the meantime. The problem is that most retail investors don't do this. They buy bond funds, which never mature. A bond fund holds a constantly rotating portfolio of bonds and never hands you back a specific principal amount. So when rates rise, your bond fund loses value, and unlike an individual bond, it has no guaranteed recovery date. This is a critical distinction that I would wager most people watching right now have never thought about. Let me hit you with another angle on this that almost nobody discusses: the hidden tax inefficiency of bonds. Bond coupon payments are typically taxed as ordinary income, not at the lower capital gains rates that apply to most stock dividends and long-term stock profits. So not only do bonds often deliver lower returns than equities over long time horizons, they also deliver those lower returns in a tax inefficient way. If you're holding bonds in a taxable account and you're in a higher tax bracket, you could be losing a meaningful chunk of your yield to taxes every single year without fully realizing it. Holding bonds inside tax-advantaged accounts like an IRA or 401k is generally a smarter approach, yet this is something the majority of investors just never consider. Now let's talk about the yield curve, because this is another area where the confusion runs deep. The yield curve is simply a graph that shows yields across different bond maturities. Normally, the curve slopes upward, meaning longer maturity bonds offer higher yields to compensate investors for the added risk of tying up their money for longer. But sometimes the curve inverts, meaning short-term rates are actually higher than long-term rates. An inverted yield curve has historically been one of the most reliable leading indicators of an economic recession. It doesn't cause the recession, but it reflects the collective expectation of the bond market that rates will need to come down in the future because economic conditions are going to deteriorate. Investors who understand this can use the yield curve as a valuable signal. Those who ignore it miss one of the most important economic indicators available to any market participant. Here's something else worth considering: the relationship between bonds and your overall financial psychology. This is where I want to come back to Morgan Housel's book, The Psychology of Money, because understanding your own emotional relationship with risk is foundational to every investment decision you'll ever make. This book doesn't just explain concepts, it rewires how you think. Housel writes in a way that makes complex behavioral finance ideas genuinely accessible, and the chapters on risk tolerance, long-term thinking, and the role of humility in investing are directly applicable to everything we've been talking about today. If you've ever made an emotional decision with your portfolio, bought high because of excitement, sold low because of fear, or held something you didn't truly understand because it felt safe, this book was written for you. It's one of the most impactful finance books of the past decade. It's an incredibly fast read, and I genuinely believe it will change how you approach every financial decision going forward. The link is in the comments below. Go grab it, because the investors who understand the psychology behind their decisions are the ones who consistently outperform the ones who don't. Back to bonds. One of the smartest things you can do as an investor is understand your actual purpose for holding any bond. Are you holding it for income, for diversification, for capital preservation, for speculation on rate movements? Each of those goals requires a completely different approach to bond selection: duration, credit quality, maturity, tax location, whether you use individual bonds or bond funds. All of these decisions need to flow from a clearly defined purpose. Most investors skip that step entirely. They just buy bonds because someone told them their portfolio should have some bonds in it, without ever asking why or how. Let's also quickly touch on credit risk, which is the risk that the bond issuer actually fails to pay you back. Government bonds from stable nations carry minimal credit risk. Corporate bonds carry more. High-yield bonds, sometimes called junk bonds, carry significantly more. The higher the yield, the higher the risk you are being asked to absorb. There is no free lunch in bond investing, just as there is no free lunch anywhere in finance. So are you one of the investors getting bonds completely wrong? If anything in this video surprised you, the answer is at least partially yes. And that's okay. The goal isn't to feel embarrassed about what you didn't know. The goal is to close the gap between where your understanding is today and where it needs to be to protect and grow your wealth over the long term. If you found this video genuinely useful, do me a favor and hit the like button right now. It takes 2 seconds, and it helps this content reach other investors who need to hear exactly this. And if you want more videos that challenge conventional financial thinking and actually give you something to work with, subscribe to this channel. We break down the concepts that matter without the noise. See you in the next one.